All right, I think we'll get started. I see some familiar faces in the audience. Let me introduce myself. I am Joe Lonizak. I am the downtown design specialist with both the Wisconsin Main Street program and the Connect Communities program. And we're with the Wisconsin Economic Development Corporation, or WEDC. I've been in this position for about 13 and a half years, long before, or back when it was even Department of Commerce. And so I work with building owners, business owners, and helping them restore their buildings, have a good working relationship with the Wisconsin Historical Society and other entities in helping to get a lot of these done. And I want to start right now just with some thank yous, because there are a lot of people that helped put this together, and people that agreed to do this on a lovely warm afternoon in February. First of all, the city of Milton for this great space that we're in. Hopefully everyone found it okay and weren't like me and had to do a U-turn because you missed it. Also, this whole thing started with a discussion from the Milton Historic Preservation Commission, and they talked to Inga Cushman from the city to ask if we could have this done. And so Inga contacted me, and I contacted other people, and here we are. And we're really pleased with the turnout. I think we have over 50 attendees that registered, and some that are showing up today. So that's great. Also want to thank the Wisconsin Historical Society. Jen Davo is here with us today, and as you can imagine, with the changes in the tax credit program, they've been pretty busy. So it was really important that this be a regional type of training, and it certainly has turned into that. We have people from as far away as Green Bay and Milwaukee, and Prairie du Chien pretty much covers the entire state. So I guess regionally, it's the whole state. So that's a great thing. And then Wisconsin Department of Revenue, we have Craig and Dale here, who I'll introduce in a little bit. They have a lot of times, Jen and I'll get questions that deal with the building itself, but it's difficult sometimes for us to answer questions that are tax related, because I am certainly not an accountant, and I will never dream to be. And then we have Tim Weber from our office in the back, and he's going to talk about WEDC's role in tax credits, on the state tax credit program. Now, just so you know, we are going to talk today about income producing buildings. There are multiple historic tax credits, and some of them deal with residential. We are going to focus today on the income producing. If you have additional questions on the residential, I think Jen could probably answer those questions, off either after the presentation or via phone call or email. I just want to take a second, because it's really nice that we are in Milton talking about tax credits, because they have done a lot of great things with historic preservation. One of the things that's kind of unique about Milton is they are one of the only communities of their size that has two downtowns. They have the, I don't know the names, but in the red are two downtowns that are about a mile apart. And that's pretty unique. And part of the reason for that is because back in the 1800s, they were two communities. And in the 1850s, both were changed to Milton Junction because the railroad came in. And then in the 1960s, they were merged. So it became one community, but two downtowns. Within those two downtowns, I hit the wrong button. I hit the wrong button again. Within those two downtowns and around them are a lot of historic buildings. And one of the greatest things about Milton is the Milton College Historic District. A lot of great buildings, a lot of great history. Some of you who are familiar with National Football League, Dave Craig of the Seattle Seahawks is one of the last graduates before Milton College closed up in 1982, I believe. But the college started in 1844, so even before Wisconsin was a state. And up till the point that it closed, it was the state's oldest historic state college. I think a lot of you may have passed the Milton House here in Milton on your drive-in. It's amazing to have a city this size have such a national important landmark in their downtown. And if you don't know the story about that, it was the founder of Milton is Goodrich. I can't remember his name. Joseph Goodrich, and he built the first house here, and he also built what was really a concrete or a grout structure, one of the first hexagonal grout structures in the country, actually. And what it's really famous for now, not just its architecture, but that it was so important on the Underground Railroad. It's actually one of only 14 buildings left in the United States that is recognized as an Underground Railroad station. So pretty amazing for Milton to have that. So our presenters today are Jen Davo, and she is the Senior Preservation Architect with the Wisconsin Historical Society. She's going to talk about the brunt of the actual tax credit review process, application process. And then we have Dale Cleveland and Craig Quammen from the Department of Revenue, who are going to talk again about the actual nuts and bolts about the tax credit process. And then we have Tim Weber, like I said, from Wisconsin Economic Development Corporation here to talk about our role. With us here today, I said that I was going to point them out, and I'm going to, but Jason Scott is here. He is with the Wisconsin Economic Development Corporation as well, and he is one of our 5 community account managers throughout the state. And when it comes to the state rehabilitation tax credit, they are usually your first point of contact besides Jen or her counterpart Mark. So Jason is one of 5, and you have this map here. So depending on your region, if you can find the county, that is who you would want to contact. What we're going to talk about today, are, like I said, the income-producing buildings. We're going to talk about eligible properties, eligible expenses, as well as I'm going to talk a little bit about the federal non-historic tax credit, which some of you may or may not know exists. And then we'll have Craig and Dale talk about the tax credit stuff. And then after Tim is done, we'll have Jen do some case studies, because it's always nice to see some real-life examples. Now, a lot of you have read in the paper that there's been a lot of changes to the tax credit program. And that's part of the reason why we're here today. Now, there have been some recent discussions that have been coming out of the governor's office, but we wanted to make sure that what we're going to talk about today is exactly what is in place right now. Obviously, we're not fortune tellers, so we don't know what exactly is going to happen with the any proposed changes. So we're going to talk about what is available today. Just a recap of what occurred in probably the past year and a half as far as tax credits go. As many of you may know, there was always a federal 20% tax credit, but then the Wisconsin had a 5% supplemental state tax credit to go along with that. And that was in place for many years. But then in 2013, previously, or very briefly, it was increased to 10%. And then shortly after that, it was increased to 20%. And as you can imagine, it was very popular. During that time, when that was created, there was never any 10% non-historic tax credit for the state. There was only the federal. So the state government decided to enact and create a 20% non-historic tax credit as well, along with the 20% historic. This might all be confusing, but then that's kind of why I want to go through this. Some of you may have heard that there was a moratorium put on both of them last summer, and that was because they had projected $4 million in tax credits, and after 6 months they had, what do I have here? I think it might be in the next 35 million in the first 6 months. So obviously they kind of got scared and wanted to take a step back and find out, what the value was, in relation to the credits. So right now, the moratorium was lifted not long after that on the historic tax credit, but the moratorium is still in place on the non-historic. Now again, I'm talking about the state credit, not the federal. And then I'm going to go to the next slide. And I apologize because I can hardly see either of these screens. But right now, where it stands is they're having people look at the actual impact, because obviously when there is this much interest in the tax credits, it's cutting into some revenue for other state programs. So they're taking a look at impact studies, and I mentioned that there are some recent developments. In the last budget proposal, Governor Walker proposed a $10 million cap statewide for the 20% state historic tax credit. We don't know, again, if that will go through. We would imagine there will be some changes, but what those are, we're not sure of. Just to compare, well, let me back up. Whatever is decided upon, WEDC, Wisconsin Historical Society, Department of Revenue, it will be our job to, to carry through with whatever is decided. So it's really going to be up to the legislator to tell us what that is. You can read that however you want to. Just by comparison, some of the states surrounding us, Minnesota, Iowa, Illinois, etc., when it comes to the cap and what they provide, Minnesota matches the federal, so they have 20%. They don't have any annual or per project cap. Iowa, they have a 25% tax credit. They do have a cap, but it is $45 million, as opposed to the $10 million that is proposed right now. That is divided among different types of projects, rural, urban, things like that. There is no per project cap. Illinois has a 25% tax credit. There are no annual caps, but this one is only for riverfront projects. And then Indiana has a 20%, and they have a pretty small cap, $450,000, $100,000 per project. And then finally, Ohio, they have one of the best programs in the country at 25%. They have a $60 million annual cap and $5 million per project. So they're getting a lot of great projects through that.
Joe, is that for non-historic or historic?
This is for historic. Yep. Thank you.
Because of the cap limitations, would you know when you're going in, you could qualify if the money's there, or you take a risk? Is that a question?
Does my non-answer answer that? Yeah. Okay. Okay. Like I said before, now we're going to kick this off, but I want to make sure to remind everyone that we're going to be talking about the income-producing buildings, and we will focus only on what is in place right now. So with that, I would like to turn it over to Jen Dable.
Thanks. What's that?
Up and down cursor.
Got it. Okay. Hello. Thank you. My name is Jen Dable. I'm one of two preservation architects at the Wisconsin Historical Society, and my job is to review tax credit applications, both income producing and homeowner, as well as we also review state, county, municipal owned historic projects, historic building projects, anything that is done with tax credit, taxpayer dollars, to make sure that the project won't be, the building won't be mucked up in the process. Anyway, so thank you for having me here today. I'm going to talk about the income producing historic rehabilitation tax credit. As Joe mentioned, we have 20%, currently we have a 20% federal income tax credit and 20% state. And I just wanted to, I'm sorry, I think I have to stay here. I just wanted to let you know that throughout my presentation, I have photographs in the slides, and these are all tax credit projects. And so I like to quiz my audience. How many folks here own historic buildings, commercial historic buildings? Awesome. Does anybody know these two buildings here? We have folks from all over, right, Joe?
Yes.
Okay. Upper left, this is the Charles Hung Bakery in Mineral Point, Wisconsin, and this is just finishing up a historic tax credit project. And the one on the lower right is the International Harvester Building in Madison, and they have done 2 tax credit projects. All right, so first question I get, building owners will call me and say, okay, I'm interested in a historic tax credit project. What do I need to do? There are 3 qualifications, 3 things that you have to meet. The property must be a certified historic structure. We're going to talk about what that is. There's a glare, isn't there? Okay, it's a good thing I've done this a few times. The property the property owner has a minimum investment that they need to put into the building. And the third is that the project must meet the Secretary of Interior standards for rehabilitation. How many people have ever heard of that? Secretary of Interior standards for rehabilitation. Okay, good. Fantastic. We're going to have a little refresher course. No, but that's okay. All right, so we're going to go back to the first one. The building must be a certified historic building. I have some images here, just some prints of our website. How many have visited the new Wisconsin History website? What do you guys think? Is it an improvement? Yes. You can tell me. Okay. Okay. Well, the first thing, oftentimes building owners will call and say, my building's old, I don't know if it's listed. We'll go on to our website, and we have a database too, but you can do this on your own. wisconsinhistory.org, and you enter your property address, and something like this will come up on the right, and I have some circles here. You're going to want to look down at the designations and see what it says there, because many folks don't understand. Our inventory is just that. It's an inventory of buildings across the state. We don't just have buildings that are listed on the state or national register on our website. We have all kinds of buildings on our website. So you want to definitely look under the designations and see if you have a date, because oftentimes people will think that their building's listed just because it's on our inventory. But I always say that you can call me and I can certainly help you with that. So sometimes you have an old building, but it's not yet listed. And you say, well, how do I know if I'm eligible for tax credits? We have this form, and it's called the National Register Questionnaire Form. Has anybody in this room filled one of those out before? Anybody? What'd you think? Was it hard? No. Thank you. I didn't tell him to say that either. It's not hard. It's a form full of questions. And really, we just ask the building owner fill out as many questions as he or she knows about the building. If you have any historic photos, any information at all, and you send that in to us at the Wisconsin Historical Society. And there we have what's called the Resource Evaluation Committee. We call ourselves REC, which is kind of funny. But we review these National Register questionnaire forms, and we look at those buildings and we review and see if, in fact, they would be eligible for listing. Peggy Verrigan, I have her name and phone number on the slide here. She is our interim National Register coordinator. And so if you did have any questions about your building or the questionnaire form, which you can get on our website as well, or you can call me, you can certainly call Peggy as well. So oftentimes I'll have people say, well, my building is 100 years old, so I'm eligible, right? No. There are 4 criteria that we review buildings for, eligibility criteria. The first is a historic association, which means this building has it has a relationship. It was a founding place. Something important in history happened there. I should say that. Does anybody know this building in the upper right?
North Hall.
There you go. UW-Madison campus, North Hall. And why is North Hall significant? It was the first building constructed for the university. Oftentimes people think it's Bascom Hall, and that's not true. North Hall was the first building constructed, and so that building is individually listed on the state and national register as the birthplace of the university. So that's a great example of A. B is association with a person. And so, yes?
All the
There you go. She wants the gold star, even before I got to ask. Yes, on the lower left, that's Aldo Leopold's shack. And so that building, if you were to look at it, you'd think it's just a shed or a chicken coop behind somebody's house. Why on earth would that be listed on the state and national register? Well, it is in fact listed because of its association with Aldo Leopold. Very important building. And C, buildings can be listed for their their significance as a design, either architectural design, it could be engineering, it could be a type of construction. And does anybody know the building on the lower right? That's where I work, exactly, Wisconsin Historical Society. And that building is listed individually as one of the best examples of the classical architecture. D is not something that we're going to talk about with this group. D is archaeological sites. And so oftentimes we have burial mounds that are listed on the state and national register because of criterion D. All right, minimum qualifications. So we know a property must be certified in order to be eligible for the owners to apply for the tax credits. The next one is the minimum investment. But before we go on, does anybody know this building on this slide? Yes. Orpheum on State Street. And that is currently in the process of a rehabilitation, and they applied for state and federal tax credits. Okay. This is where I have to let you all know I'm just a preservation architect. Money is not my skill set, unlike our friends from the DRR over there. So there's a different financial prerequisite for the federal and the state. For the federal, you're, as a building owner, you need to put into your project equal to or greater than the adjusted base value for that property. Or $5,000, whichever is greater. Now, when I first started this position, I thought, what on earth is this? What am I talking about? But I've done this presentation a few times. So, the adjusted base value is what you purchased the property for, minus the value of the land at the time of purchase, plus any improvements you've made to it since you bought it, minus the depreciation. That gives you your adjusted base value. So the National Park Service, IRS, is going to want you to put in equal to or greater than that amount, or $5,000, in order to qualify for their 20%. And then I thought, once I understood the adjusted base value, I thought, well, that $5,000, that's ridiculous. But then I learned that once you own a property for, is it 15, 20 years? I'm looking at my money guys over there. Somewhere in there, your adjusted base value tends to near zero. And I had a gentleman who owned a commercial building in downtown Chippewa Falls Historic District, and he said, I would like to apply for the tax credits. I'm replacing the roof on my building. And the first question I asked him was this one. And I said, sir, how long have you owned the building? And he said, well, Missy, I think I bought it in about 1958. I said, I think you're okay. So he applied and he got his 20% tax credits for simply replacing the roof. So this is a good one, important one to know. The state, as Joe mentioned, January 1st of last year, we increased our state tax credit to 20%. At the same time, they also decoupled that tax credit, meaning that owners who do not qualify for the federal 20% can apply simply for the state, as long as they're putting in more than $50,000 into their project. And so because of that, we had last year a few projects that the owners did not qualify for the federal, but they qualified for the state, and so they were able to do that. And actually vice versa. There are some that worked the other way as well. They didn't qualify for state, but they did federal, as the example of Chippewa Falls. All right, so eligible expenses. So when we talk about putting money into your building, not everything is eligible for the tax credits, if that makes sense. And so I have a slide up here. anything that you're going to do to your historic building, inside or out, is eligible. The fees that you're going to pay your architect, engineer, consultants, those are all eligible for the tax credits. Consultants. To get your building listed is a great example of a consultant. Items that are not eligible for the tax credits include new construction. Oftentimes, folks add on to their buildings. They put on an elevator addition or something that is not an eligible expense. Landscaping and parking lots is not an eligible expense because it has nothing to do with the historic building. And movable equipment, refrigerators, dishwashers, those things an owner could simply move out when they sell the building. I just wanted to also throw this in here. I had a project this past year that the original building was constructed in 1889, but in 1959 there was a sizable addition put onto the building. This building is still listed. It's still eligible for the tax credits. And a lot of the work was going on in the 1959 addition. And they said, is this work eligible because it's not part of the original building? And I said, yes, it is. Because once an addition is put onto the building, it's the entire building. And my friend Clayton Gallagher at the IRS says, we don't draw lines through buildings. So we don't say, this part is eligible, this part of the building is not. So if you think about it that way, once your addition is there, whether it was put on 10 years ago or 100 years ago, that work would be eligible as well. Does that make sense?
Would one exception be if it's a different address? If the addition is a different address? Or...
Yes. The IRS goes by address. Thank you, Joe. And that's why sometimes this gets fun and tricky, and I have to put on my architect hat and say, call our friends at DOR or IRS. And so it does get a little tricky sometimes, but new buildings, separate addresses. Yes, thank you. All right. So we have a historic building. We have our costs that are going to be more than the adjusted base value or more than $50,000. The last is all work must meet the Secretary of Interior standards for rehabilitation. And this one is a fun one, I think, because the standards are interpretable. And my colleague Mark likes to say, the best thing about the standards are they're interpretable, and the worst thing about the standards is they're interpretable. So we're gonna go through these a little bit. So I saw some hands. You guys are familiar with these standards. You've worked them with your buildings before. Do I have any architects in the room? Designers? All right, fantastic. So these standards were written by the National Park Service quite a while ago, and they're the guidelines. They're kind of the go-to book for rehabilitation. And while they are interpretable, Mark and I have a pretty good grasp on how the state of Wisconsin, how we interpret the standards, and we're in line with the National Park Service and our reviewers in Washington, D.C. And so I'm just going to go through a couple of these. It's kind of fun. I think it's fun. Okay, so buildings, with your projects, we're going to want your project to maintain the identity and the integrity of the building. Does anybody know the building on the left? Black Point, the newest Wisconsin Historical Society site. Thank you. Black Point is an awesome example. It maintains both identity and integrity. That building hasn't been changed at all since its original construction. Meaning the original owners can come back and look at that and say, that's our house, right? The building on the right is a one-room schoolhouse in Wisconsin. It maintains its identity, but unfortunately not its integrity. And what I mean by that is the Friends group that owned this one-room schoolhouse loved it too much. They replaced the siding, the windows, the doors, the roof. They rebuilt the bell tower. Inside, they ripped up the wood floors, the plaster on the walls, the lights. The only thing historic about that are the studs, the wall studs. It's the only thing left from its original date of construction. And so that's what I mean with integrity. When you have a building that's a certified historic structure, we're going to want, and when I say we, Wisconsin Historical Society and the National Park Service, we're going to want you to maintain those two things. And that's what Mark and I and our reviewer in DC is going to be looking at. Standards number 2 and 5 talk about preserving character-defining features. It's it's something I think we all know. When we see our historic buildings, we see these elements, these features on historic buildings that we love, that you don't find them in new construction. Those are character-defining features, meaning we don't want you to lose those features if at all possible. And we're going to want you to be able to repair those things and retain them. Do not falsify history. This is not in Wisconsin. This is actually located in Colorado. But Mark and I call this putting lipstick on a pig. Don't do that. So you have a historic building. Maybe it's the most ornate in the city. Maybe it's not. Or maybe it's in the middle. Wherever it falls, let your historic building be that. And we're not going to want you to add lipstick or fake brackets or anything else like that, or a fake facade. So we're going to look at that when we review your project. Sometimes historic buildings acquire significance after the original date of construction. And these are 2 examples of storefronts and signage that were added probably during the Deco, 30s, 40s. And these are examples of another very important architectural style. It defines a time in the history of the building, and it's still there. And so if you owned a building with one of these, and it's called structural pigmented glass, oftentimes it's Carrara or Vitrolite were the brand names. If you have a building with a storefront like that, obviously, well, it's probably not the original, but if you said as part of your project, we want to rip all that off and we want to rebuild the original, we may question that decision. Not always, but that's something to consider with your storefronts. Repair before replacing. This is in standard number 6, but it's kind of repeated throughout. Our character-defining features are just that, and they're also part of the building's integrity, meaning that they were built with old-growth lumber. Our original wood windows are very durable because they were constructed with old-growth lumber, and old-growth lumber is very strong and durable. And so we're going to ask you to repair those windows before you replace them, even if they look identical. I have building owners say that. What if they look just the same? Remember, you're losing integrity with that and by replacing those windows. And I could talk to you for another 3 hours on windows, but I won't. We'll keep going. Number 7 is do not harm your historic building. Fortunately or unfortunately, there have been some contemporary methods for cleaning and with our tools that can really harm our historic building materials. Sandblasting is one of them. Did you know there's a state statute against sandblasting a historic building? It's true. My colleague Mark told me this, and when I first started, and I said, "You're making that up. You're just saying that." But it's true. We looked it up. There's a state law against it. And simply because sandblasting creates irreversible damage. You can't fix a brick once it's been sandblasted. Repointing, there's many examples. And so with your project, we're not only going to look at what you're planning on doing, but how you plan on doing it. And so we're going to ask, how do you plan on cleaning your building? What products? That sort of thing. Number 9 and 10 of the standards refer to new additions, new construction. We, the Historical Society and the National Park Service, understand that buildings grow and need to change and improve with times. And so additions are not looked upon unfavorably, but it's all in the details. It's all in how it's done. Does anybody know the building on the left? Yes. Yes, thank you. I can't call on Joe anymore. Joe knows too many of these. That's the Mabel Tainter Theater in Menominee. And on the left, you can see the addition that was put on at the rear of the building. And that was a very sympathetic, appropriate addition in scale and materials and design. The other two, however, are not located in Wisconsin. I think these two are in North Dakota, where additions have been added above on the roof. And you can see that that has greatly altered the identity of those historic buildings, right? It's greatly changed the massing and the appearance from the main facade. So we're going to look at that. And just keep in mind, even though new construction is not an eligible expense, we still have to review it and it still needs to meet the standards. Oftentimes people say, why? If we don't get tax credits, why do you get to review it? And this is my response. The state and the federal government are giving you, the building owner, an incentive to appropriately rehabilitate your building. If you're doing all these appropriate things, but at the same time constructing an addition seen here, you're at the same time maybe doing something good as doing something bad. So that's why we have to review the entire project. Okay, application process. I'm going to stop at the examples, right? I'm stopping at examples. Okay. So application process. This is when I say, I think the application process isn't so bad. Has anybody in here applied for tax credits before? I should have asked that first. What do you guys think? Did you think it was bad? Not too bad? I don't know. I always say you get to work with me, and I'm one of the nicest people I know. Now, Mark, on the other hand, I'm just kidding. Okay, so the first step with your application process is call me or Mark. I have the western half of the state. Mark has the eastern half. It's by county. But if you call one of us, we'll send you to the other one if you've got us wrong. But let's do a site visit. That's always the best way to start off this application process, so that I can come and meet you on site. We'll walk through your building, and you can tell me what you want to do. Sometimes it's really easy. We need to update mechanical, electrical, and plumbing. It needs a new roof. Sometimes it's just real simple. Sometimes it's more elaborate than that, and so then we kind of get more into the standards and we talk about appropriate versus inappropriate. And the reason why this site visit is so good is it's really going to streamline your process, your application process and timeline. I have gotten applications before without going on a site visit, and it does it takes a lot longer for me to review those, and sometimes I end up going out there anyway because I need to see the building. All right. To get your project approved, there are two parts, part 1 and part 2. And for the state, there's another form. We're going to start with part 1. Part 1 has to do with the eligibility of your building. Sometimes buildings are listed as contributing buildings in a historic district. Those buildings are eligible for tax credits. I need to say that because I've done so many talks and people say, my building's only contributing, but how do I get it listed? If your building is contributing, it is listed. So you are eligible for tax credits. If you're contributing, you still need to do the part 1, even though it's kind of a check, because the National Park Service knows. If your building is individually listed, not part of a historic district, you do not need to do this part 1. Yes?
What if you found a lot of information that's in your part that was already submitted that you found is wrong and you've done a bunch of historical research?
I suppose you can always send another one in, but the new information that you have is not going to change the status of your building. I guess,
To update, I guess.
yeah, I guess it would be
You guys have
for,
better records.
yeah, for informational purposes. That's a great question. I'm gonna have you call Peggy. So this part one, I think I'm gonna talk about this later. Okay. Okay. I want to mention this now. Let's say you went down the route, your building's not yet listed. You did a National Register questionnaire form. It came into rec. We said, yes, definitely, this building is eligible. Go ahead and do a draft nomination form. And that gets submitted with the part one. Before you can claim tax credits from the federal government, your building has to be listed. Okay? So what I often recommend to building owners that did that questionnaire form is once you get a yes, we think it's definitely eligible, you have that consultant keep going. Have that person complete the nomination, send in the part one, then it comes to our state review board, then it goes to the Park Service review board, because that whole process could take a year. Okay? So don't wait. Don't put that on the sideline. Unfortunately, we have had building owners that after they received a, yep, your building looks to be eligible, they thought it was listed. We're done. And they missed out on the tax credits then. So keep going, doing that part one application at the same time that you start doing that part two application. The part two application is the description of your proposed project. And sometimes, depending on the scope of your project, it can be quite involved. And if it's a large project, there's building drawings associated with this portion. There's definitely photographs. And this description is really important because our reviewer for Wisconsin is Liz Petrella in DC. And Liz does not get to come out here and see the buildings like I do. So I do a site visit with you guys. I come back. A month later, I get your part two application. I've been there. I can understand this as I'm going through it. Liz can't. So you need to give her really great photographs and a really great description. But part one and part two, I get 2 copies from you of everything because I keep one and I send one on to Liz in DC. Does that make sense? Okay. The last form is the WEDC form that is required for your state tax credits. And this is a form that is put in our packet if I mail you applications. Otherwise, all of these application forms are on our website, wisconsinhistory.org. And along with those application forms is this WEDC application. This form comes in with your part two to me. And once I feel that your project, I can conditionally approve your project and forward it on to DC, I will then forward your WDC application on to Steve Sabaki. But I don't know what happens after that. Are you going to talk about that?
Yeah.
Okay, perfect. To learn later in the session. Okay. So that's where it goes. But I can't forward it until we get a project that looks approvable, right? All right. Timeline and costs. Your design, your planning, your project planning, that's up to you guys. I've seen some owners do it in a week and some take a year. And that's completely up to you guys. Once you submit a part one and a part two to my office, we technically have 30 days to review it. I can't say it always takes 30 days. It just depends on our workload. Joe alluded to this, but this is a fun fact. In 2013, prior to the 20% the tax credit, Mark and I reviewed about 13 income-producing tax credit projects. We had 250 homeowner, but that's a separate thing. In 2014, when we got the 20%, we reviewed 43 income-producing. So our workload more than tripled. But that's great, and it's fantastic. But it also means that we're going on that many more site visits and that kind of thing. So it just depends. There's also busier months than others. So right now it's not busy, just to let you know. We forward it on to the National Park Service. Technically, they have 30 days. Again, it's going to depend on Liz's workload. Our reviewer has Wisconsin, North Dakota, South Dakota, Maryland, and one other state that I forget. So it really depends on what's going on in those other states as well. And as I mentioned, to get your building listed, if it's not yet listed, can take up to a year. So I would get starting on that right away. The Wisconsin Historical Society does not charge a fee to review your applications, but the National Park Service does, and that schedule is located on this slide. It's depending on the cost of your project is the fee that is allocated, and they've made it really easy now. Once they receive your Part 2 application, they email you and say, you can go to pay.gov and pay your fee. And once they receive your fee, they will review your application. Yes.
Just to clarify, so you can submit your part 2 at the same time that you're submitting your National Register nomination, right?
Yes.
Correct.
Yes. And oftentimes folks do that. They don't submit their Part 2 until they hear back from REC saying, yep, your building looks to be eligible. They get their consultant going, and really with the Part 1 then, we're going to need a draft nomination. So that can come in at the same time as your Part 2, and I would recommend that. It looks like I'm done with my portion. Are there any questions for me? Yes.
Does it require a consultant to write the nomination?
Good question. Does a consultant have to write the nomination? No, they don't. We excuse me, we oftentimes recommend that simply because it's a small thesis paper. There's a lot of research and writing involved, and consultants can do it. However, if you have those skills and are interested in doing that, by all means you can. Yes.
And then do you know what about figure for the nomination?
It really depends of the fee, the cost for a consultant to write a nomination. It really depends on the building size. How many buildings? Is it a district? Maybe for a commercial building, it could be as little as $2,000 or $3,000. For a district, it can be up to $10,000, $12,000, depending on the number of buildings. But remember, that consultant fee is eligible for the tax credits. Any other questions? Yes.
I have a question. For eligibility of a building, if the building had been mucked up over time, so when you come out to your site visit, you find that, no, it's probably not eligible, but the rehab work that's being proposed would revert it back to
Yeah.
its, not pristine, but its most status. Would there be any way that that building could become eligible?
Yeah.
And get tax credits to do the rehab on its original?
Yeah, it's a great question. So our buildings aren't always pristine as how they looked when they were constructed. This is a great example I can give. You've all seen downtown commercial buildings that have metal slip covers put over them, metal panels. We've all seen that, right? Across the state, we have historic districts, and they're contributing buildings and non-contributing. And if, when that district was listed, there were those metal panels over it, so the windows aren't there, the brick's not, you can't see it, that building is listed as non-contributing, okay? If you own one of those buildings now and you'd like to apply for tax credits, before you can apply, you're going to have to just remove that metal siding. And unfortunately, that's not going to be eligible for the tax credits. You need to do that to show us and the Park Service that, yes, the historic building is still there, the brick, the windows, any storefront. And then once you just remove those panels, then you can apply. And we've had that example many times across the state. Any other questions? Yes.
Earlier you were talking about repair versus replace. If there's like a portion of something that needs to be repaired, but it would be easier to replace the whole thing and it's not 100% original to the building, is that something that would be considered that you could replace at that time?
It depends. we would look at that, and you know, obviously we look at cost prohibitive. Some things are cost prohibitive, and so we consider those things, and we consider if this element is not original to the building. There are many things, but it's hard. There are no hard and fast rules simply because every building is so different in every case. So we really do look at each building.
What do you consider cost prohibitive? Like, I know you don't like, you said you could talk for hours about windows,
Yeah.
and windows are a big thing, you know, when you're redoing a building. Because the new windows, they make them look old, they're way more efficient,
Mhm.
there's just so many pluses.
Mhm.
So to rebuild the old windows to make them, to get them to be efficient, maybe every window would cost you $2,000.
Mhm.
You could buy a replacement, you know, for $500. What do you guys consider too much money?
Well, I think we'd go back first and say, are the windows deteriorated beyond repair? Because that's one of the standards. And if they truly are deteriorated beyond repair, we're not going to make you keep them and fill them with epoxy. Sometimes it's not all the windows that are deteriorated beyond repair, but maybe a quarter of them are. And there's an intensive window survey that we ask the building owner to do. And the reason is because windows are a character-defining feature of the building. And there have been many studies that show adding a storm window to the interior exterior of your original windows, along with weather stripping and that sort of thing, can produce as just as effective result as replacing that window. And so, again, we'd have to take a look at your building example and analyze it and review it. But to answer your question, I think that and there's been this situation where there's 100 windows on a building and 75 of them are deteriorated beyond repair, the Park Service doesn't make you keep 25 of them. They're going to let you replace them all. So, all right. I'm coming back to give case studies. So if you think of more questions, I'll be back.
Thanks, Jen. And David, I think your question was very a good segue into the next part. And that is what happens when you do have a building that is not deemed eligible for listing on the National Register. And there are a few examples around the state. I actually these aren't case studies, I don't know all the details about them, but just to show you some examples of, these are projects that got in before the moratorium on the non-historic pre-1936 state tax credit. So one of them is the Fort Atkinson Club, not too far away in Fort Atkinson. As you can kind of see on the right, the upper photo is the historic photo. The two on the right are what it was when they applied, and you know, most of the historic character is gone. A lot of the character-defining elements are gone. But because they got the 20% non-historic tax credit when it was still in place, they were able to bring it back to its original. The Meyer Theater in Green Bay, the building to the left of it on the upper right photo, they want to expand that into, you know, more usable space, but the storefronts had been altered over the years and kind of muddled over, so it wasn't eligible for tax credits, but still a beautiful building. So they were able to utilize that 10% or the 20% and the 10% federal. This is a great example in Rice Lake. The old city hall had been the bell tower had been taken off, and so many things were changed. Window openings were infilled. So obviously it didn't meet the National Register listing criteria. But you know, with the non-historic tax credit, they were able to do that. A lot of industrial properties have changed over time to a point where, you know, windows have been infilled, taken out. This is one example in Racine where they've utilized the tax credit. This is probably one of the more known in the state, Larson Green in Green Bay, where because almost all of the windows have been infilled at some point, they did not qualify. But I think everyone would agree that a huge project like that, an industrial project in the downtown, being converted into new mixed uses is huge for economic development. So that's why the historic tax credits are very important, but what happens to these buildings that fall under that radar? And so that's why it was so incredibly popular. But just a really quick recap of what the non-historic tax credit is. Now there is a 10% federal, and again, like I said, there was a 20% state, but that has been put on moratorium, and in the governor's budget, it's going to be repealed if everything goes through. So I'm just going to right now talk about the federal 10%, because that's all that exists. This is for buildings that were built prior to 1936. Now that date stays as it is. It doesn't advance every year. It similar to the federal state tax or the federal tax credits. It is the rehab expenses must equal either 5,000 or the adjusted basis, like Jen talked about. Now this one, as opposed to the historic tax credit, which are for income producing buildings, which can also be residential if it is rental housing or things like that. This cannot be used for residential. So commercial only. The building must remain in its original location prior to 1936. So it couldn't have been moved if it was a depot and it had to be moved for added train lines, it would not count. Now the problem, I consider it a problem with this program, is there is no formal review process. So I'll admit I've tended to only recommend this to communities where they have like a local design review process in place, just to make sure that taxpayer money is going to projects that really are well designed and it isn't going to ruin the historic integrity that is left of these buildings. So even though there is no formal review process, there are a couple what I would consider kind of odd requirements. And that is, one is that 50% of the external walls must remain in place as external walls. So what you plan to do must keep those in place. 75% of external walls must remain as either interior or exterior walls. And then 75% of the internal structure must remain in place. Now that's odd. I've never seen a formula on how to actually determine that, but it's a little different. And different than the historic tax credit where you have the mainly two-part application process. This is simply once the construction is done and the building is placed back in service, you simply submit IRS form 3468. And this is just a one-time, so it can't be carried forward multiple years. So that is the 10% non-historic tax credit, the federal. Any questions on that before I turn it over to Craig and Dale? Yes?
So there's no original application process? You do the work and then apply for the credit afterwards?
That is my understanding, yeah. It's pretty simple.
For the residential portion, so if it's a two-story building that has, say, storefronts downstairs and apartments upstairs, would that not qualify, or the downstairs would and the upstairs wouldn't, or how would that work?
Well, for the historic,
For the
okay. Now I just want to say for the historic, if you have, you cannot use it for any part that would be the owner's primary residence. So in a case where it's a 10-unit apartment building and 9 of the units are going to be for rental and 1 for owners, they could take the credit for the 9 and not for the 1. As far as the 10% tax credit, I believe that, and I will admit I don't know the answer to that for sure, but I believe that you can get the credit for the portion that is not residential in a mixed-use building.
Well, then also, could you not, for that 10th unit and the 10-unit upper floor residential, could you have an LLC and then rent it from yourself, and it would become income producing? The tax guys.
That would be
It's possible.
I suppose, because if it's an LLC, especially for the federal historic rehab, the partners need to. I mean, you would be a limited partner in it with liability, so I don't think you'd be able to get around that. Nice try, though. All right, Craig, there.
Good afternoon. I'm Craig Quammen from the Wisconsin Department of Revenue, and I work in our Administrative Technical Services section. So basically, I deal with everything tax related, and this is just one of the many credits that I end up dealing with. With me, my colleague Dale Cleveland over there. He's not into public speaking, so not that I am either, but I drew the short straw today, so you're stuck with me. I will apologize, I don't have any pictures of historic structures in my presentation. We're strictly numbers people at the Department of Revenue. Oops, and I'm going to break this thing already.
Down cursor, that's what I'm
Just down, okay. I have to get out of this first. There we go. Okay. So as Joel pointed out, the supplement to the federal historic rehabilitation tax credit used to be a 5% credit for the state, and then in 2013 it was changed to 10%, and then beginning with 2014 it was changed again to 20% credit. So when you combine that with the federal 20% credit, you can get a 40% tax credit for rehabilitating historic structures, so it's a pretty lucrative deal. It covers a significant portion of the costs. There is one thing that the budget bill does provide, the second bullet point up there, the pre-1936 structures. That provision, as the budget currently stands, is going to be removed. So beginning on or after January 1st of 2015, pre-1936 structures would not qualify for the credit. It would have to be a certified historic structure. And the budget bill also provides, though, that if you are currently incurred expenditures prior to 1/1 of 15, you're still able to claim the credit after 15 if you did have pre-1936 expenses but hadn't taken the credit yet. So nobody's going to lose out here. It's being phased out essentially. The other major law change in 2014 was that the historic credit can now be transferred or sold to other taxpayers. And the reason this is significant is that there are nonprofits out there that will never owe a tax liability, so prior to this transferability, the credit meant nothing to them because the credit is a non-refundable credit. So that means it can only reduce your tax liability to zero. So if you don't pay a tax because you don't have taxable income as a nonprofit, the credit means nothing to you. So there's no incentive for a nonprofit to claim this credit. Now that it can be transferred, a nonprofit or a taxpayer that has losses or other credits and may never utilize this credit can actually claim do the historic work, claim the credit, and then they can sell the credit to another taxpayer. So it allows more flexibility. So they're not going to lose out on receiving benefits from the work. And so some of the criteria to transfer these credits, the transferee must be subject to tax. So basically in this case, partnerships are the one entity that cannot get a credit transferred to them because they don't pay taxes. It also, DOR must certify ownership of the credit, and so that's what we do. There's really not a lot there. We just make sure that the person transferring the credit actually is in fact, entitled to the credit. And then once we determine that, we send a letter to the transferor verifying that yes, they do in fact have this credit to transfer, and then the transferor can give that piece of paper to the transferee to prove that yes, I am going to sell this credit and I do have ownership to it. And so obviously no one's going to pay for a credit unless there's some sort of certification that they have the credit. So that's essentially what we do. We do verify that the transfer is going along the lines of the law, and that just means that basically the entity transferring the credit is paying taxes or is subject to tax.
Kind of confusing. I just like, so you have a 501c in your city.
Mm-hmm.
In an old building, they do a bunch of renovation work, they do this credit, okay?
Correct, yes. Anybody that's willing to buy the credit as long as they're subject to taxes.
That's for the state. That's for the
I've never
state.
heard of that.
Yeah, this is only a state. Federal you can't sell credits. This is a state. Just strictly the state credit. Does it it's only happened once so far. There's been a lot of interest shown in it, but we've only had one person actually
Like 501c doing $100,000 worth of renovation, have a $20,000 credit. If some major person that donates a lot to the 501c, they can sell you a $20,000 credit for maybe a $5,000 each. I mean, right? I mean,
correct.
it's tougher dollars.
The terms correct. It's all up to the transfer and transferee. It's because without selling the credit, there's no benefit for the 501c to. They can't use it to offset their tax liability. So instead of, having no benefit, at least if they have a $20,000 credit and they sell it for 15, they're actually getting some benefit versus nothing. So that's the idea.
I'm surprised you guys allow it.
It's the legislature, not us. Yes.
And Craig and Dale are talking maybe about the state. You can technically sell the federal credits as well, but it's a lot more complicated. The people buying the entity buying the credit has to be in an LLC with you and be partners from the beginning. Whereas with the state, for 5 years. Whereas with the state one, the new rules are 5 years.
I'm kind of new to this, so I ask a lot of questions. I'm sorry.
No, it's okay.
Like when you get the credit, I know on one page, where you were, it said, the 20% state credit, $44,063 in your example. Is that a 1-year credit? So you need
It's
to owe at least $44,000?
no, it's carry forward. So if you can't utilize the full credit, you have 15 years to
Okay.
reduce your taxes each year by the remaining balance. It's okay.
I have
Yes.
a quick one too, and I'm not sure. So, is it possible if you were a nonprofit or whatever, you don't have tax liability, could you potentially sell those credits in advance of getting them, if the person's willing to take the risk, to get some cash to do your improvement?
The question was, can you sell the credit in advance to get capital to fund the project? Essentially, we generally speaking, we will not certify a sale of the credit until it can be claimed, which is typically when it's placed into service. So we will accept the credit transfer applications quarterly. So if someone doesn't want to wait till the last second to do it all, but for us to certify it, it has to be when the building's placed into service. So unfortunately, it can't be done ahead of time like you were asking. And we do have a new form, the HRT, which we have the transferor fill out to basically apply for the credit transfer. And this is probably hard to see, but this is what the form looks like. There's really not much to it. It's just the name and address of the transferor and the transferee, the qualified expenditures, and then 20% of those. The one line to keep in mind here is line 7. You don't have to transfer the full amount of the credit. So if you anticipate maybe you're going to have a tax liability, or what some people do, there are tax ramifications with selling the credit. So if you sell the credit, whatever you receive for the proceeds of the credit is capital gain income for federal and Wisconsin purposes. So some people will withhold a portion of the credit for themselves to pay the tax on the transfer. That's one thing a lot of people tend to do. So that's something to keep in mind. And then line 8 is just the actual amount transferred. So I know you'd asked if we've only had one person transfer this credit, but you can transfer the early stage seed investment credit as well. So we've had numerous people do that. So that's where I have a lot of experience in the credit transfer. So working through that, a lot of times they'll withhold a certain portion of the credit so they don't have to pay the tax on the capital gains. The instructions for the form are on the back of the HRT. Basically, here I just want to, when you send this form to us, we're going to ask for certain items. We want the certification agreement from the WEDC, the transfer documents, so those are the expected sale documents. Obviously, it hasn't been finalized yet, but we want the initial documents. If it's coming from a pass-through entity like a partnership or a S corporation, we want the K1s. And if the partnership is going to allocate the credit based on something other than the ownership percentage, we want a copy of that agreement. Once we get these documents, we'll look it over and make sure everything's legit, so the person transferring it does in fact have a credit and that it's being transferred to somebody that actually is going to owe a tax liability. And usually within a month after receiving this schedule, we will send out our letter certifying that yes, this credit can be transferred. One piece of advice is not to wait until the end of the tax year. We had a situation in December where they sent the documents in like the day before Christmas, and there was an issue with how the structure was set up, so it got a little hectic there when there weren't many people around the office. So if you do know ahead of time, like this project was completed in July, so I don't know why they waited till the end of December to do this, but if it is completed, I suggest submitting that HRT as soon as possible. So if there are issues, you can just redo the organization structure to make everything work within the frames of the tax law. And if you do have questions on this, I just want to highlight the email address there, IS&E Tech Services. That's a good place to send those questions, and we can get back to you in writing. Or if you'd prefer a call, we can call you back too that way. As far as claiming the credit, Schedule HR is used to claim the credit, and this will be used by both the transferor and transferee. So, a couple items to highlight here. Part 1 is the supplement to the Federal Historic Rehabilitation Tax Credit. And if you're transferring the credit, line 5, if you're receiving that from other taxpayers, so you'll complete this form, and if you bought the credit, you'll fill in on line 5 the amount of credit that you purchased. If you are selling the credit, line 9 is the amount transferred to other taxpayers. So you'll still fill out this form, compute your credit at the top portion. Let's say you want to sell it all and you compute a $100,000 credit on line 1 or 2 up there. It's hard to see with the glare. And then if you transfer it all on line 9 of $100,000, your actual credit as the transfer or is going to be 0. It just gives us a accounting of who's doing what here, so we can keep track of this as well. Second part of the form, part 2, is the state historic credit. That one is not transferable. And then part 3 is just information on who the transferor and transferee is. This is from the instructions for Schedule HR. As mentioned before, there is a provision that if for some reason you're out of compliance with the historic requirements, or you fail to use the property within 5 years as historic property, there's a repayment provision. So if a claimant is required to repay the credit, it actually goes back to the original claimant. So if I sell the credit to Dale and then I'm out of compliance, Dale's not liable to repay the credit. It comes back to me. So the liability is on the seller of the credit. So if you as a purchaser really don't have any liability here if something goes wrong with the credit, which is a good thing, because then you're not bound by somebody else's mistakes here or choices. And the carry forward period, as mentioned before, it is a non-refundable credit, so it can only offset your tax liability down to 0. Any remaining credit you don't use to offset your taxes can be carried forward for 15 years. However, when you do transfer the credit, you inherit the remaining transfer period of the original seller. So if I transfer the credit to Dale and I have 10 years left of the carry forward, he now has 10 years. It doesn't start over with a new 15-year period. So that's just something else to keep in mind. And there are tax consequences with this, as there always are. The seller of the credit is going to recognize capital gain treatment between their basis in the credit, which is generally zero unless they purchased it from somebody else, and the fair market value of what they received for the credit. So if I'm the original claimer of the credit and I sell that to Dale for $100,000, I have a $100,000 gain, and it's a capital gain, meaning that, and its character is short or long term is based on the holding period. So if I had the credit for more than a year, it would be a long-term capital gain, or if it's less than a year, it's a short-term capital gain. And then the purchaser of the credit has a capital gain as well. It's the difference between what they paid for the credit and the amount of their tax liability they're going to offset. So if, in this case, Dale bought a $100,000 credit from me, but he only paid $50,000 for it. So basically he's getting the credit for 50 cents on the dollar, or 50%. So if he uses $10,000 of that credit on his tax return, he'll recognize $5,000 capital gain each year he uses that transferred credit as a short or long-term capital gain, again, depending on when the tax credit is used to satisfy the tax liability. So now we're just going to run through some of the common questions we have on the transferability of the credit. First question is, in order to transfer the credit, I'm required to notify the department. How do I do this? You'll just submit Schedule HRT, the certification agreement from the WEDC, and the proposed transfer documents. One thing that does help us out here is if this is a complicated structure, you have multiple entities within it, it helps to have a flow chart diagramming who's getting what. The first one we had was pretty complex, and without a flow chart it would have been impossible to see what was really going on here. So it helps to have an organizational flow chart. Unless it's something simple like me to Dale, I think we can figure that part out. The second one, does the Department of Revenue impose any fees on the transfer of a credit? We do not, so that's a good thing. I know, like with the early stage seed credit, the WEDC can impose a 1% fee, so this one does not have any fees associated with it. The tax consequences, again, for the transferor, it's a capital gain, and the capital gain is equal to the difference between their basis and the credit, which is generally zero, and the money they receive for the credit.
I have a question on that.
Yes.
So is the net credit, so capital gains is taxed at 15%. And income
Correct.
taxes are, let's say, 30%. So is the net benefit to the transferee 15%, the difference between that?
It's for the transferee, essentially, it would be the 15%. And that's one thing people have to take into account when they, trying to figure out how much do I want to pay for this credit, because the credit's diminished by the fact that there are taxes on it. And obviously no one's going to pay full price for a credit because it wouldn't make sense. So generally these credits are selling for, I wouldn't think anything more than 80% of their face value, because otherwise it doesn't make economical sense to do it. Yes?
Question, how long is the ability to transfer credits, how long has that been expensive?
For this credit, it just started in 2014. The early stage seed started in 2011, I believe. And now there's another, the economic development tax credit can be transferred as well. That was just recent. So right now it's just 3 credits that can be transferred. Next question, are there any restrictions on who the credit can be transferred to? This, again, it can only be transferred to somebody that actually is subject to an income tax liability. So in this case, partnerships would not qualify because they aren't subject to taxes. If this question was asked earlier, you've entered in an agreement with the WEDC for a transfer of the credit. May a credit based on the certified amount be transferred? And the answer there is no, because the certified amount is just basically amount saying, yes, we have this amount. We're going to certify you up to this amount as eligible for the transfer. However, you still have to meet the requirements of the Department of Revenue certification in order to be transferred. There is a provision that allows the credit to be claimed based on when the expenditures are paid. So then how often do you have to submit the Schedule HRT certification to the Department of Revenue? And we are going to allow it as frequently as quarterly. However, just keep in mind that we won't certify it as being able to be transferred until the actual applicant can claim the credit, which is typically at the end of the taxable year. So we won't certify it until, if you're a calendar year taxpayer, that means we won't certify it until, essentially the December 31st of the tax year. Yes?
I got one question. Back to this transfer.
Mm-hmm.
You got a $20,000 transfer. Transfer for the person giving the credit. Is a gain?
Correct. Yes.
Transfer, do you have a gain?
Yes, they do, based on the difference between what they paid for the credit. So if I paid $10,000 to get your $20,000 credit, that's a gain because you're getting.
Okay.
Yep. Yep. Next question. What notification is required when the transfer is completed? And this is what I explained to you previously. Both the transferor and transferee will fill out Schedule HR when they file their tax return. The transferor to indicate that they actually were eligible to compute the credit, and then to show they transferred it to the transferee. The transferee will show that credit that they purchased as a transfer from another taxpayer. Another question is, may the credit be transferred more than once? The answer here is yes. Just keep in mind, every time you transfer it, the value of that credit diminishes because of the taxes and just the fact that no one's going to pay 100% for a tax credit. This question has to do with the carry forward period. So can a credit from the 2014 tax year be transferred in 15 or later? So let's say you compute a credit for 2014, a historic credit, and you're not interested in transferring it right now. However, 2 or 3 years down the road, you feel like you're never going to be able to utilize that credit. Can you transfer the credit at that point? And the answer is yes. Just keep in mind that 3 years that have passed, the carry forward now is to 12 years for the person you transfer it to. This credit has to do with if the credit that is awarded to the initial claimant is later disallowed because they didn't keep up with the requirements of the Historical Society on the credit. Is the transferee liable for repayment? The answer is no. Only the original person the original person that rehabilitated the property is only subject to repayment. And here's the question: you bought a $50,000 credit for $43,000. What amount can you actually claim? As the purchaser, it's the full value of the credit, the $50,000. The tax consequences to the transferee. Again, it's the example of if you buy it for $10,000, but its face value is $20,000. You, as the purchaser, has a capital gain for the difference of $10,000. So if you do purchase a 2014 credit in 15, are you able to amend your return and claim that credit in 14? The answer there is no. The tax year you can use the credit for is the year in which you purchased the credit. And if the purchase credit is not claimed in the full year purchase, can you continue to claim the credit in future taxable years? And the answer is yes. It's subject to the 15-year carry forward. And again, that starts, you inherit the carry forward of the person that you're purchasing the credit from. Finally, it's some additional resources, the HRT, which is the transfer document, and the instructions. Schedule HR, which is used to claim the credit, and instructions are available on our website. And we do have the common questions that we just went through as well. Otherwise, if you do have questions, the email address, ISNE Technical Services at revenue.wi.gov, which is in the back of the Schedule HRT, provides good information. Yes?
I know for confidentiality reasons, you can't disclose who purchases them. I would say that across the country, I've noticed that a lot of banks are purchasers of these. Do you know if a bank purchases credits, can they use that to offset their, community reinvestment requirements?
The question was if a bank purchases these credits, can they use that towards their community reinvestment? Is that?
Yeah, like they're required to invest back in it.
I do not know offhand if that does qualify. If they do purchase the credits and they're a C corporation, they can use the credits to offset their tax liability. I'm not sure about the community reinvestment program.
Shouldn't be, because basically not really putting anything into the community. But they are, but
They're financing the project in some cases, but I'm not sure I don't know the details of what the reinvestment is on that. Any other questions? Yes.
Way back at the beginning, I didn't quite understand what you said about the pre-1936 20%. Did you say that it was being considered all the way through 2014?
So yes, currently the pre-1936 structures qualify for the credit. There is a provision in the budget that will do away with that. So it has to be a certified historic structure then. And
Was that even after the moratorium?
this is right. This is a separate budget provision it's separate from the moratorium. So if the moratorium is in place and you can't claim the pre-1936, that still applies too. So I'm not sure how the moratorium is interacting. If we've already met that, it sounds like possibly. I'm not sure.
Well, there was a moratorium in June, and that part was not lifted.
Okay, so then no one knew. Okay, so if somebody started a project prior to June and they haven't finished it yet, they're still able to claim the credit based on the pre-1936 even after the budget provision takes place, assuming it does. Because the intent is not to have somebody spend the money, thinking that this is still going to be in place and then pull it out from under them. It's whoever had expenditures prior to 1/1/15 when this would take effect, they can still claim the credit based on those expenditures. Yep, go ahead.
So a separate question is, for 2014, if you have Part 2 approved, will WEDC write a contract for that state tax credit no matter what, or is there any limitation?
That I don't.
2014?
So in 2014, this is are we talking pre-30s?
No,
This
I'm
is.
sorry, I'm talking for qualified, certified buildings.
Do you wanna build that one?
yeah, we're still, that's still an active program, so. That's my, you're just talking about the not, you're talking about the qualified building.
Right.
The question is, if you're doing work on it, you already have the approved Part 2? Yes, it should, if they've already approved it, then it'll come to us and one, right?
At what point do you get a contract from the WEDC?
It should be 3 to 4 weeks after we get sent over from. We're gonna talk about this.
Okay.
Keep track how much funding we have, or when you get to that point, you stop it. Well, right now, there's no cap. We do keep track.
Yep.
So if the transferor is a 501c3,
Mm-hmm.
are they subject to the 15% capital gains tax since they're a nonprofit, or would they not have to have that liability?
That would depend on whether the credit is considered part of their unrelated business taxable income, essentially, whether or not they have to report it or not. I don't know if that's. I'm thinking generally they would not be subject to that because I'm thinking it would fall in line with their intended profit or their charitable organizational structure, how they're structured. So I would say no, they were not going to be subject to that. Yes.
So not a 501c3 owns the property, doing the work. It's totally feasible though that a local business or bank might buy those tax credits at full price because to help the project, they're either gonna pay the money to the project or they'll pay the taxes. But they get a little more boost in the community because they were involved in the project.
It's possible they could. To this.
I mean, that's
No, and they can certainly pay whatever they can pay over if they'd like. I mean, no, it's
if they have no, and if they pay full value, there's no capital gain because.
right. Correct. Yes, exactly. Yes. So yeah, they can structure it however they want. And if it somehow benefits them to pay full price, they're certainly entitled to do that. Yep.
Maybe easier making a contribution to the project.
Mm-hmm. Sure. True. Any other questions? All right, we'll turn it over to Tim.
I'm Tim Weber. I'm from the Wisconsin Economic Development Corporation. I'm the tax credit program manager there. So I help manage this program along with a bunch of other tax credit programs that we have. Our piece in the historic tax credit process is what I'll talk to you about. It's relatively small compared to other projects that we do. We get this, which is the application for the WEDC with the other part 1 and part 2 from Jen. Once we receive that, then it goes to Steve Sabatke, who is the financial services director. He'll assign it out to an underwriter and an account manager, which I think Joe showed you earlier. It depends where you are in the state who your account manager will be. But if you have any questions during that process, that's the person you'll want to contact. But basically, since they have already recommended the building to us and already basically certified that it was historic, or before when we could do the pre-1936s. We're not going to take any look at the architecture or any other pieces of that they've already done. We have plenty of work to do besides that, so we don't need that. All we're really going to do is just do a background check and make sure basically that you are legal to receive Wisconsin tax credits. So we're not going to want to, so if you have a state tax lien or even a federal tax lien that's unpaid, usually we're going to try to get that paid or get on a payment plan. And then besides that, most credit issues are not going to be a problem. If you have 5 foreclosures in the last 2 years, obviously we're going to have some doubt that you're going to be able to complete this project. So that's something that we're probably at least going to talk about. But usually, only if I've seen about 2 out of 60 projects have we had to ask for anything else. Usually all we get is this form and then the part 1 and part 2 from the Historical Society. It's generally pretty quick underwrite. In about 2 weeks, we'll take it through our internal process and then take it through our management review process. And then at that point, we're going to start contracting. And really that's, what they refer to as a certification is a contract that we have with you that basically just says we certify up to, 100,000 historic tax credits for this building to this entity. And really then once you have that, you have to prove, when you earn the credits on the back end. But that's basically WEDC's portion of it. Which is pretty simple. Anyone have any questions?
certified for a larger amount and then actually be able to claim a smaller amount?
Right. I would say yes, but I mean, you want to be at least ballpark where you're at. But we've done a couple now where, you know, the project came in at 15 million, and then 2 months later it was 17 and a half, and I amended it, and it was okay. We're done with this guy. Then like 3 months later it was 20 million, and we were amending his contract again and again and again. So the more accurate number you can start with, the better. We don't have to grant that obviously increase, so it's not guaranteed. So if you come in at the lower number and then you come in with a higher number, you know, we don't have to do the amendment. The amendment runs through them first. Once we get part two, once they do it, then we'll look at it again. So you're better off just to get the most accurate number you can at the beginning. Obviously, I know that's hard with some of these projects, but that's my recommendation. Any other questions?
You said $50,000 is the minimum.
Yeah, for the qualified piece of it. So when we're talking about this, it's, you know, the project might be a couple million, but the qualified amount of it might be 500,000. So the credits are only based on the, you know, the qualified piece of this, which Jen could probably talk more to. Yeah. You know, the one other thing, obviously going forward, we're not sure if some of the projects, we might be looking at different variables when we underwrite them. That's all to be figured out down the line. But obviously, this year we went to about 60 million in credits that we gave out, 15 million for the pre-1936 and 45 million for the qualified rehabs. You know, if that cap really gets dropped to 10, obviously you're going to have to start doing things to differentiate those projects. So there might be more emphasis put on jobs created, or, you know, what type of building it is, that sort of thing. But all that stuff we don't really know at this time. Any other questions? We're good. Thank you. Oh, you got one.
Do you know where the $10 million figure came from?
No idea. No, not from us. Any other questions? Thank you.
All right. I think I'm the last one, and we're gonna have some fun showing you some case studies. Let me just. All right. All right. I have 3 different case study projects. I tried to pick different sizes. These are all from my side of the state, so sorry, eastern half. This one is called the Treats Block. It's a building, contributing building in the Monroe Street downtown historic district. It's right across the street from the courthouse. I put in the dates in here just so you can kind of get a sense of, you know, when we received things, when we forwarded them to the National Park Service, and when it was approved. I won't go through all of those, but what's really interesting, so this building, the Qualified Rehabilitation Expenditures, QRE, is what you're going to get your tax credits on. So that's the eligible amount of work. This one had $200,000. Was the estimated. The actual came in at 220. So they received 44,000 in state and another 44,000 in federal income tax credits. And I just wanted to show you a little bit like what happened. On the lower left, there's an original photo. I don't know what all those boxes were that were stacked in front of it. On the upper left, you can see that awesome permastone that they put on mid-century. So the beautiful original storefront was buried. And then how the owner restored. Some of it was restored, some pieces were left, and some of it had to be reconstructed. You can see up above windows, probably in the 70s when they made windows really small in all the buildings, right? They did that to this building. And on the right, you can see the photo. The owner reinstalled the full-size windows to match the originals because the originals were gone. On the rear of the building, you can see it's an alley side. You know, you have some glass block, you have a lot of vents. And this owner was able to open up those original masonry window openings again. on the inside, it was pretty bad on the inside. When I went on my site visit, I saw that permastone on the outside, and then I walked in here and I thought, wow, this is bad. But the after was fantastic. And just to give you an example, so all of this work, exterior and interior, were eligible for the tax credits. All right, that's the treats block, and that is a very typical project across Wisconsin. Every downtown has those kinds of commercial buildings, right? We all know them, and so in 200,000, that's pretty average. Chippewa Falls has done a couple that same kind of scale and scope, $200,000. So here's the Longfellow School, and this is located in Madison. Now, while this one's in Madison, I can tell you in 2014, Mark and I received 6 applications just for historic schools, and they were all being converted to residential. So again, this is Madison, but it could be anywhere in Wisconsin. So you can see their estimated QRE was $6 million, and it came in at $7.7 million. So this is one of those examples that Tim was probably talking about. And they received $1.5 million in tax credits from the state, and also $1.5 million from the federal government. This project I wanted to talk about because let's talk about character defining. We talked about features. There's also spaces. So schools have awesome historic gymnasiums and auditoriums and corridors with transoms and lockers. With these kinds of projects, we want them to keep those spaces. So here's some after photos that I wanted to show you. These are original stairwells and hallways that were left. The lockers were even left in place. But it's pretty cool. In Longfellow Lofts were the residential units were full before they even finished because people wanted to live in an old school. They left chalkboards and shelving units in the apartment units themselves. So kind of fun. It's a fun project. This is what I wanted to tell you about, though. This application, I don't know if you remember seeing this, but let's go back to the dates. The Part 2 we received on June 6th. It was approved on October 21st. Dun, dun, dun. And this is why. It wasn't the rehabilitation, it was the new construction on this site. And this was very, I guess everybody in Madison knew about this one because everybody was talking about it. But you can see, yes, the existing building is on the right, the rectangular mass there. The new addition is on the left-hand side, and it's kind of that U rectangular. That's a big addition, right? And while it was put at the rear of the building, that's where the playground was and the basketball courts and all of that, the Park Service said, go ahead and build there. But originally this addition was taller than the historic school. It came out beyond the side elevations, the side street elevations. The materials were not right. And so there was a lot of back and forth between the owner, the architect, myself, and Liz at the National Park Service to get this just right. And again, all of this work that held the approval up is not eligible. But if they wanted to get tax credits for the eligible work, we had to approve it all. So this is one example with new construction. The last example I wanted to show you was in Wausau. It's the federal building. Is anybody familiar with the federal building in Wausau? Of course, Joe. And what is your name? Dawn. Dawn here too, Joe. You're not the only one. The Wausau building in Federal is an awesome building. In 1999, the federal government sold it to the city of Wausau for $1 because they were essentially decommissioning the building, the courtroom inside, the post office, the state senator's offices. I think Feingold's office was there. I remember seeing a nameplate. Anyway, so this building sat vacant since 1999. And a developer came through and said to the city of Wausau, we want to we want to do that. We want to redo that building and get tax credits. So they entered into a long-term lease agreement with the city of Wausau, so that they could rehab the building. So the city still owns it, and they lease it to the developer. And I think it's a 40 or 60 year long-term lease agreement. But in that way, the city owns it, but they didn't have to rehab it. They didn't have to do this. As you can see, it was estimated at 4.1 million. Came in pretty close to that. This was completed in 2013, so I believe they received the 10% state income tax credit and then 20% from the federal.
So on that one, how did they deal with the ownership business? Federal, they got the federal credits, right?
Mm-hmm.
But the city owned it.
The city owned it, but because it's a long-term lease agreement with the developer, which is a for-profit, that's how they were able to get the state income tax credits and then also federal. And as a preservation architect, that's all I know.
The developer was the applicant.
The developer was the applicant, not the city.
Okay, but the city still occupied it.
No, the city doesn't occupy it, they own it. Mm-hmm. Mm-hmm. The city leases it for 40 or 60 years to this developer. Mm-hmm. Which is quite common too. We see that across the state. So this is a case, this building is fantastic. And well, there were some insensitive things that were done over the years. You can see on the left, the doors had been replaced. And on the right, you can see the architect and the developer chose doors to match the originals that were there. This was a case of the windows that the gentleman in the back was asking about. The owner originally applied and wanted to replace all the windows in the building. And when it came to me, and I was even there, I said, I don't think these are deteriorated beyond repair. Sometimes folks mistake peeling paint for deteriorated beyond repair. And this was a case that the owner was asked to do an intensive window survey, so they had to take pictures of every single window. So I have pictures of a lot of windows. And I just showed you a couple of them. In the end, the Park Service gave the owner the option that they could replace the windows on the rear of the building, but the other 3 sides they had to repair and retain. They did install storm windows, however. On the interior, this building is fantastic, full of character-defining features and spaces. Here you can see on the left the original lobby of the building, and it had these murals, WPA era murals that are still there and are kept there. On the right, there's the leather doors in the courtroom. The fan was still there. They left the fan too. And then on the lower right, the courtroom as well. Really great features about this building. The safe they left. It was in the offices that's left in one of the apartments. Also the jail cell on the bottom. They kept that, and that's it's walled on the other side, but I think it's a bedroom. So some kid thinks it's really cool. His bedroom's in a jail cell. So anyway, I just wanted to give you 3 examples of the types of projects we see, but as you can see, there are never 2 that are exactly the same. So it's a lot of fun. I have my email and phone number. I also have a ton of business cards if you want those, if you want to hand them out to other folks, feel free to. But that's it. Joe, did you have anything else?
I don't think so. I know it went a little longer than the hour and a half, but I hope that was because there were a lot of great questions. Hopefully you still get back in time.